Right now, India is moving more earth and pouring more concrete than at any point in its history. New transit networks, commercial hubs, and industrial corridors are being carved directly out of the landscape. Building at this scale requires an immense volume of heavy machinery, a market that has historically been the domain of established global brands with decades of reach. Yet a primary beneficiary of this spending is Action Construction Equipment, or ACE, a 31-year-old brand that manufactures its equipment entirely within India. The company recently reported its highest ever quarterly revenue, paired with an expansion in operating profit margins. How did a local manufacturer position itself to capture such a high percentage of this national infrastructure spending? The strategy wasn't to compete on every front at once. Instead, they built a foundation by achieving overwhelming dominance in one specific category of machinery. That foundation is the pick-and-carry crane. Today, ACE is the world's largest manufacturer of this specific type of mobile crane. This dominance is reflected in the data. In the mobile crane segment, ACE holds a 63% domestic market share, leaving only a third of the market for all other competitors combined. They also hold 60% of the domestic tower crane market, meaning most of the vertical construction in India's cities is supported by their equipment. Controlling nearly two-thirds of these markets provided the capital to build a defensive moat, a dense, highly localized sales and service network. That network now covers over 125 locations, supported by 13 regional offices. For a foreign competitor, this physical presence is a massive barrier to entry. It is nearly impossible to match the support speed of a brand that already has technicians in almost every major industrial hub. Once the service pipeline was established, ACE used those same locations to distribute new lines of machinery, becoming India's most diversified equipment manufacturer. Their current revenue split shows how far they have moved beyond just cranes. Combined, manufacturing, logistics, and infrastructure now account for 80% of their end-user exposure. Real estate and agriculture make up the remaining 20%, giving the company a presence in nearly every physical sector of the economy. Balancing sales across these different sectors while integrating AI-assisted tools into their manufacturing gave the company the leverage to drive margins up even as material costs fluctuated. As a result, operating EBITDA expanded by 145 basis points in a single quarter. This spread of revenue across infrastructure, agriculture, and manufacturing means ACE no longer relies on a single sector to stay profitable. There is a natural limit to domestic growth. Once a company captures the mid-tier market, the only path to further expansion is moving into premium, heavy-duty machinery. To enter this segment, ACE formed a 50-50 joint venture with the Japanese manufacturer KATO Works. This partnership transfers Japanese technology for crawler and truck cranes directly into ACE's manufacturing platform. This move allows ACE to supply the heavy machinery required for India's largest bridge and refinery projects without years of independent research and development. By combining domestic manufacturing scale with specialized international technology, they can now compete for the heaviest lifting contracts in the country. ACE's growth followed a clear logic: dominate a core niche, build a service network that keeps competitors out, and then use partnerships to enter the heaviest tiers of construction. They are a multi-sector manufacturer, now integrated into the landscape of India's largest worksites.